Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a fun show with the EIA data. It'll be a little bit shorter. You know, some of the normal charts that we use, they didn't update just because of the holidays. So we tried to supplement as best we could, just to give you the same type of color that we try to. So it was very seasonally normal in terms of what we saw. You know, we had a draw from crude, we had builds and products. Again, like as we've been saying on the crude side, they're going to continue to push oil away from, and liquids in general, away from PADD3. Again, try to reduce some of that, some of those taxes at the end of the year, which is leaving more in Cushing, pushing more into the export market. You know, one of the problems that we've seen and that we've been talking about is what is going to happen when floating storage increases in the Middle East, and we've already started to see that. We thought it was very likely, especially when you saw prices going up. You know, Iraq, it was a bit mixed. Some prices went up, some they kept the same. And you can see that there is this slowdown in terms of buying from the Middle East, and that we've seen a little bit of an increase from the West Africa. But again, this is that shifting that we're continuing to see in the market in these adjustments. And then on the U.S. side, we're seeing an additional steady increase of exports. We're right around that target that remember when we took it higher from 2.7 to 2.6 to 2.8. Then we said 2.8 to 2.9, and right now we're right in that sweet spot. So we had a small decline of product demand. Again, that was just a seasonal drop, and typically you get a spike, seasonal drop, and then this week we should get a nice little increase, especially given how much driving we've seen so far through the Wednesday of this week. Something that will continue, and then that'll drop off. And depending on when people come back, because next week is also a slow week, so we could see 2 weeks of a lull, if you will, in terms of product demand before things start to get better once again. So before we go into some of the very specific numbers that we normally talk about, I just wanted to touch on briefly on LNG. Now we have a bunch of models that we do, and clients have requested them. So we just wanted to touch on and provide a highlight. This is just looking at total exports. So you can see exports are right near a record for going back through 2015, but we had a record export from the U.S. and that's not something that's going to stop, especially when we're seeing and this is why I love watching the boats and the AIS transponders. We had a boat do a full U-turn right when it was getting to Asia to go back into Europe. So Europe is now pulling more LNG. Pricing dictates that we might actually get some re-exports from Asia into Europe, because the European pricing is the strongest. So the U.S. being the closest, you're starting to see as much spot going from the U.S. into Europe, which is going to support activity, especially in the natural gas basins, as we've been alluding to in our FSC shows, in terms of Haynesville, that what we deem as other, which produces a lot of dry gas. We're going to continue to see a lot of this activity, the focus around there, and then obviously meet some of these demands. And the reason why is because when you look at entry physical, and this is also looking at this specific chart is today, but then when we look a day ahead, there's nothing scheduled. So again, we're seeing a very big slowdown in physical flows coming into Europe. Now, Russia gas flows to Europe dropped this week as some buyers under long-term deals have already hit their contracted supply limits. Now, there's always a minimum, and the minimum is set early on with a price, which, given where the spike happened, is at a lower price. So that means that everything additional you want to buy is going to be at market price. So if you look at where market price is, that's why they're just not opting to buy anything new, because they're going to try to use storage. They're going to try to work off the lower cost product before they're forced to go in and pay the higher price. So these are some of those difficulties, and that's why we're starting to see more LNG get pulled in. They're trying to play the game of finding the lowest cost in a massively rising cost environment. Gazprom and its customers typically arrange a minimal volume and must be supplied and paid for each year under a preset formula that this year allowed much lower prices than those at trading hubs. If a buyer wants more gas, they have to pay the prevailing market rate, which topped 180 euros a megawatt hour this week from less than 20 euros at the start of the year. To give you an idea, 180 euros versus 20, to give you an idea of what that supply limit looks like. Europe's gas prices soared about 20% this week as the reduced shipments from Russia reinforced concerns of a worsening winter energy crisis. Freezing temperatures across the continent before Christmas is also boosting heating demand and cutting into already record low gas volumes. And that's when you look at gas, European gas storage is at critical levels, and you're seeing how it's already going to get drawn down, again, attracting more. And eventually, these companies are going to be forced to pay whatever market price there is to bring some of this physical natural gas in, as long as it's still available, because Russia can also play the game of, well, what about Nord Stream 2? What about what's happening in Ukraine? And that's where the geopolitics can get very interesting. So that's a quick update on what is happening in Russia, between Russia and Europe. Why is it happening? And then what does this mean going forward? So when you look at global crude on the water, you can see that we had another big spike. Now global crude on the water is looking at storage and transit because we want to get a whole picture of what is out there. Seasonally adjusted, we're at all-time highs. For 2021, we're at all-time highs. We're at 2021 highs. So again, you're seeing this big pickup. But that's with a lot of crude that remains in storage, not getting pulled on shore, and then additional shipments that have now gone in motion that are sitting in floating storage and/or have gone from floating storage into transit. And we're seeing a lot of these shifts. And where we're seeing, again, as we said last week, we expected Asia to see some builds. We saw them again on the floating storage side, and we expected it in the Middle East as we expected drops in West Africa, all of which came to fruition. And we think that that's going to continue over the next 2 weeks, especially when you look at West Africa, where we've had some force majeure, which we'll talk about in segment 3, but we've had some slowdowns in some purchases, an increase in some others with the IOC or Indian Oil Company out of India, which has picked up about 4 million tons, which again is a nice start to that cycle. As we're getting some, again, other force majeures in Libya, and we're seeing some of that get taken down now. It's not a huge drop right now. There's crude in storage. There's crude that can make up some of it, but as some of these slowdowns at the not only just port level, but also at the fields, that'll eat into what that will actually look like going forward. Now, luckily, when you look at the market in general, January and February are fairly slow months. So because we're coming into also a slower period, that helps in terms of offset some of these disruptions. So then when we look at oil in transit, we're at 2021 highs and seasonally adjusted all-time highs. And that's why we're seeing a lot of this crude go in motion, but it's just going from one floating storage to the next, and that's where it's just getting repositioned, and a lot of that is going from West Africa into Asia, and we're seeing again in the U.S. a little bit more kept offshore. And this is that management on what PADD3 is going to do to minimize a lot of that that tax bill. Then when you look at global crude storage, and again, looking at floating storage, we're now above where we were in 2020. As we were saying, the comps get easier for 2020. And now we're just below where we were in 2016, which, if you remember, was a huge surge year when you look at the amount of product and storage in the Middle East. And that's going to be something to watch now that we expect a slow grind up as a lot of this crude in transit shows up. That'll convert to floating storage. So we do expect to finish out the year just above 2020, but below 2016, and then start off above where we began the year for 2021. So again, we still see a lot of this crude sitting offshore and struggling to really find their way into the system. And the reason why is there's a lot. So there's already a glut on the coast, but there's also renewed issues especially in China, due to some COVID outbreaks, which has slowed down some of these ports, again, created more of this congestion that we've talked about. We've had issues at a lot of these different bottlenecks, which we've talked about for months now, especially as, again, container ships try to catch up and you start to see some of these day rates start to normalize after getting some of the catch up that we've talked about. So when we look at crude stock, coming into the U.S. now, we had a draw of 4.71 million. That's 53.7 million below the 5-year average. We had a small drop in PADD 1, small build in PADD 2. Cushing had a fairly large build of 1.46 million. That brings us 17.4 million below the 5-year average. But it was really PADD 3 that was the biggest driver of that, with a drop of 3.31 million, bringing us 6.3 million below the 5-year average. But that's a bit skewed because of 2020. And we're seeing a very normal drop right now. And what we have the chart to look at, what are the previous years look like? And we should finish close to where we were, slightly above where we were in 2019 in terms of what that looks like. And then we expect to see a big pop in really the first 3 weeks of January as a lot of this starts to move back down into PADD 3. So we'll see kind of an artificial drop and then a big increase as we progress through January. And then PADD 5 had a drop of 1.62 million, bringing us 2.7 million below the 5-year average. But really, this is, again, a lot of that, some of the timing on PADD 5. We expect that to reverse. But again, PADD 3, we expect to see continuous draws as they readjust, and that'll leave more in Cushing, more on the coast, and try to marry with exports, imports to make sure that they're not getting these huge builds. And then when we look at the SPR had an extra drop, bringing the total draw to 7.25 million. And again, some of that just goes into either the import market or gets reverted back into our commercial market. We expect that to slow down because we're not seeing a huge take up of the 32 million from the additional, which was the swap. You have to pay interest on, but the outright sale of 18 million, we do expect that to accelerate and remain elevated. And then the production number, small drop, but again, this is more along the lines of just a calculation. We expect this to finish, right at about 11.7 million barrels into a day into year end. So now when we look at runs had a small drop of just 20 basis points, went from 89.8 to 89.6. Even though we had a small uptick of actual crude being run. And again, it comes down to the process with that is being reported. So some processes might have come down, bringing total utilization rate, but then you might have had additional crude or different types of crude, which could have a net, because some of these processes have net negative throughput in terms of you put in 100 barrels, you only get 98 out. So you have to put in a little extra. It just depends on how it's being recognized. So again, just a small drop. We do expect this to remain fairly depressed this week, obviously, excuse me, because of the holidays and because of Christmas. Then we'll get that recovery as we go into next week. And then a little bit of a drop for New Year's until we get back to something closer to about 91% by the first week into second week of January. So as we said last week, we expected to see an increase in PADD 3. We got an increase of about 154,000 barrels a day, with some drops in PADD 2. Some of that will remain down, with PADD 5 having a small increase of 93,000 barrels a day. So then when we look at imports were down 278,000 barrels a day, and you can see that's 1.1 million below the 5-year average because, again, it's PADD 3. PADD 3 is 1.2 million below the 5-year average. It was down 89,000 barrels. So even though it's only down 89,000 barrels week over week, you can get an idea of just how low we are versus normal because, again, they're not trying to take anything in. You've seen that slowdown. PADD 2 did have a reduction. We thought we were going to get a little bit of a mean reversion this week. We got it. It was down 567,000 barrels a day. That will now bounce. Not taking back all of it, but we do expect about 200 to 250,000 barrels a day increase. And then PADD 5, we had a decrease last week. We had an increase this week of 423,000 barrels a day. Again, that's where we get the biggest timing delay. just because PADD3 continues to struggle at the port level, especially when you're looking at not only container ships, but also crude cargoes. European gasoline arrivals in the U.S. jumped 58% through December 16th. Gasoline imports rebounded to about 252,000 barrels a day, which we were talking about because if you remember last week, we were saying that we expected, we had some sizable increases in gasoline storage in Europe, and we thought that was going to unlock some additional. And that's just going to be a matter of timing. We do still see fairly low exports, and we don't see too much of a makeup unless we get some sizable builds. But, based on what we're seeing, it's going to be fairly stable. So again, we do expect to see some of that pressure in general. European refiners are shipping less gasoline in general. So we had about 238,000 tons of clean products, mostly gasoline, have sailed to Europe from Europe so far this month, which is down about 28% from the first 21 days of last month, to give you an idea of kind of where that sits. Total exports, including Latin America, are set to drop. They're sitting at about 1.63 million tons, which is below the same period in the previous month of 1.73 million. So again, getting some of that, a little bit of that slowdown as some of the demand increases in Europe. So then when we look at implied demand in the U.S., as we were saying last week, we expected to see a drop in both disti and gasoline. We got a little bit bigger of a drop in distillate than we were expecting. But again, there's some of that big swings, even though we did get a recovery in diesel demand from trucking. But we do have weather isn't quite cooperating when you're looking at heating oil, which is gonna cap some of that underlying distillate fuel oil demand. Where gasoline, we do expect to see that spike. As we were saying last week, when we had that big increase, we expected a drop, and then we should see another rebound this week. And then next week should be fairly, depending on how much of a makeup number is this week, we could see kind of that sit sideways, and we'll show you what it's looked like in previous years to get an idea of, we're very much seasonally normal right now. So, which is a positive, but we just want to look at where we're going to shake out as we go through January. After gasoline saw a drop of 486,000 barrels a day, back below 9 million and about 99,000 barrels a day below the 5-year average. Distillate had a drop of that 1.074 million, and then jet again had that decline to about 1.46 million, which is right where we were talking about last week. We were expecting between 1.4, 1.5. Very much in line with expectations, with propane dropping 867,000 barrels a day, which is also seeing that headwind from the lack of heating demand, which is going to weigh on some of that underlying demand for propane as well. When we look at total crude oil inventories, you can see right here we're tracking close to where we were on the decline level from 2017 as well as 2019. Again, we expect to be very close to where we were in where, I don't know if you can see where that white line, yellow line kind of come to emerge. That's where we expect to close out 2021. So getting much closer to kind of that normal level, if you will. And you can see 2016 and 2020 are those two outlier years, which is really pulling up the average. But we're sitting fairly close, again, still at the low end of that. But we're going to close out fairly close to where we closed both 2017 and 2019. And then when we look at crude oil's supply, and remember, this is going to be married with what is happening with refiners. So right here, we're right in line with where we were in 2015. Then 2016, 2020 were higher years because we had so much crude. But again, this is more along because we have such reduced refinery run rates, which is why even though crude oil is where it is, we're still not at, we still have a fairly robust or an excess amount of days of supply because of the way this is being calculated and the way we look at it when you're looking at what is refinery demand and what is storage available. And so that's where, again, we'll probably close out fairly close to where we were for 2015, just because we see some of the slowdown in draws, and we will see a fairly capped refinery response until we get into January, which is going to essentially flatline us and keep us at about 27 days or just over 27 days of coverage, as we currently sit at about 27.3. Then when you look at total oil storage, oil and products, as we were saying last week, we expected just to go sideways, because we'll have that marriage between crude coming down, product builds. As we said last week, we expected a big increase in gasoline storage. We got that. We expected a little bit of a build in disti, but again, distillate is the bright spot. We did expect that huge kind of spike in gasoline, which is really flatlined us. And we expect this to continue to remain fairly flat as we go into year end. And here's that gasoline spike. As we were saying, we thought it was just going to look, and if you just look over previous years, that could be 2019, 2017, pick your year. We normally get this increase. And again, we're so very much seasonally normal on the gasoline side. Distillate, it remains at the low end. This is, again, the positive side. We should get one big increase. It'll either be this week or next, and it's going to be helped by the fact that you have truckers that are going to go home for the holidays, so you're going to get a lull on the trucking side. You'll also get a lull on the heating, just because of the way the weather is shaking out. And that'll be that nice little bump as we get one big washout in terms of demand before we get a big recovery. And then when you look at jet fuel, seasonally adjusted, all-time low. And this is something where they're leaving more in the distillate pool, and they can pull it out as needed, as jet fuel demand remains fairly weak compared to historical years, which again, we don't see that changing. Now, when we look at the curve, you can see that we're above 70 through about May of next year. Then we're above 65 through the end, essentially the middle of 2023. So still a fairly healthy spot when you're looking at investment in both, shorter term crude growth in terms of supply, looking at the U.S. And then when you look at where things have shifted, you have had a little bit of a move down in the curve in general. Just below 60 once you get past 2024 into 2025, but you're still seeing some projects getting sanctioned, smaller ones, and there's really not too much of a huge drive to do all that much in terms of increasing CapEx, but we do expect to see another increase in 2022 and 2023 of new projects getting sanctioned, as we've already seen from both Guyana, Latin America in general, as well as the Middle East. COVID cases continue to rebound. Unfortunately, the numbers are going to be below what is actually happening, purely because there's just not enough tests. So I know personally, and again, looking through the last 4 waves of COVID, over the last, this is again going to be more anecdotal from my perspective, but the last 3 waves or so, I knew some people that had COVID, but not a huge amount. Now there is definitely, I know more people with COVID than without. And this is, again, vaccinated, unvaccinated. Everybody, it seems, has COVID. Everybody has either not look, I have it. It's going through my house. I'm not going to go wait online for 2 hours to get a test that I know is going to be positive. And then they might not even have enough tests. So again, you're seeing those increases. Hopefully, that we'll see that spike, and then it'll start to wane as we get into the first and second week of January. Again, something very similar that we saw happen last year. You can see that we spiked in about the first week of Jan, and then we had a steady decline as we got into February. It should look very similar to that in general. And again, this should be across the board. South Korea, Vietnam, seeing an increase when we're seeing some steady declines in a lot of the other areas. So Europe is definitely the hot spot, U.S. as well, as we're seeing it in some other Asian nations. But we don't think it's going to result in lockdowns. You're just going to see some people taking it a bit easy, especially after the holidays. You look at PADD3, here you can see where 2019 was, and this is what we were saying. We should see another steady drop. So we should be below where we were in 2018, but a little bit above probably where we were in 2019. But again, just a very normal setup as we go into the end of the year, as they try to limit the amount of crude in storage. Now, when we look at Cushing continues to see that steady grind up. We expect to close the year where we ended the year for 2019. And again, putting ourselves in a fairly comfortable level as we go into not only the year end, but also to begin the next year. Floating storage remaining a bit elevated. We expect this to climb higher, again, due to holidays, just less people on the docks, less activity. So that'll increase floating storage, and then that should stay fairly elevated as we go into year end. It'll be below the 5-year average, but again, still fairly, we would say split the difference of where that middle of the cloud currently resides. Imports into PADD3 remain low. That's something that will have a little bit of a bounce, but not a huge amount, just because they're going to try to keep as much offshore as they can, and there's still a decent amount in storage. PADD2 had that mean reversion back to the 5-year average. We think that this will spike and come back to the high end of that cloud and remain fairly elevated, just given the amount of crude that is continuing from Canada into the U.S., and that'll keep us fairly stocked in PADD2 in terms of imports. And then when you look at refinery utilization rates, you can see that we normally flatline here. So it's a little bit below the 29-year average, and then we have a little bit of an increase that we were talking about. We expect it to follow the 29-year trend, just be slightly below, but again, still seeing a fairly normal move, and then we'll have that increase to about 91.5% by really the third week of January. So now that we've gone through the overview, we're going to dig into what is happening in the U.S., what do we expect for Christmas, the New Year's, and then where should we start out January and Q1 of 2022.